My name is Deepesh Patel, editor at Trade Finance Global and host of the podcast Trade Finance Talks. In this panel session at BAFT's global annual meeting, we're catching up with heads of trade with a view on Asian trade. The Russia-Ukraine conflict, the emergence of digital islands, and the continued COVID restrictions are certainly shaking up trade and commodity finance in Asia. But what does this actually mean for liquidity, risk appetite and trade finance in Asia, and what's the outlook in the region? Today I'm delighted to be joined by Kai Fehr, Managing Director and Global Head of Trade and Working Capital at Standard Chartered Bank, and Sriram Muthukrishnan, Managing Director and Group Head of Trade Product Management at Deepesh Bank. Both welcome to the panel.
Thank you, Deepesh. Great to be here.
Let's start with a quick round of introductions. Kai, Sriram, can you give us a quick 30-second elevator pitch? So who are you? Where are you from? What do you do? Kai, over to you.
Yeah, sure. Hi, everyone, and welcome. By the way, BAFT 100-year anniversary. Fortunately, can't be with you today. Kai, introduction made. I'm running trade for Standard Chartered. The interesting part is the trade and working capital part. We've integrated the working capital, meaning short-term lending product and overdraft product into the trade suite, make us a little bit more holistic in working capital. Clients, more to come on that. 17 years here in Singapore, proud PR of Singapore, by DNA German, but Singapore for sure now is home.
Thank you very much. And Sriram, over to you.
Hi, everyone. I'm Sriram Muthukrishnan. I'm responsible for product management at DBS. I started off managing trade, and recently the remit has been expanded to include cash management as well. And of course, we are extremely well known in Asia for our digital pedigree and the way we consider ourselves more of a tech company and a fintech rather than really a conventional bank. But those of you who haven't heard about us potentially in your markets far away from Singapore and Asia, we would love to have a chat with you to explain to you how we have transformed the business inside out at DPS to become much more digital.
Thank you very much, and we'll go on to that in a bit more detail later on. So let's just start with a bit of an overview. Obviously, we've had such a huge amount of supply chain disruptions, and corporates and banks alike are really looking for resilience in their supply chains, particularly over the past year or two. Kai, how have the persisting COVID-19 restrictions in Asian markets impacted trade, both in the region and around the world?
Yeah, I think, Deepesh, you bring us right into the core topic, and I don't think it's necessarily an Asian topic. I think it's a global topic, but certainly relevant for Asia and other markets. From my perspective, I think we will see the biggest fundamental shift in supply chains, and talking about the physical supply chains, our client supply chains, we have seen in probably the last 2 decades. The previous model of there's a workbench on one side, producers for the West, that model was slowly deteriorating anyway. But what you have now is a completely polarized world. You have disruption in supply chain, there's the impact of COVID, we have the Russian war, and that make our clients rethink their supply chain model. Just in time, is that the right model for the fragmented, polarized world? It is not. You will see in the polarized world from a political aspect, new alliances coming up. Russian oil will find its way. There will be taker for Russian oil. Who are these new alliances? Are you on one side of the polarization? Are you with the West? Are you with the East? Is a new cluster forming? All of these questions, I think they are still open, but I'm 100% sure that the world, the supply chain world as we know it, will disappear. You will have these new clusters, these new alliances, these new blocks emerging, new pipelines will be built, new channels will be open. So you need to be, as a bank, in a position to be flexible enough to have that global localist mindset. You need to be a global bank with a local mindset to prevail in the future world. And if you feel like, well, not 100% sure what you're talking about. It's not visible right now. What I'm talking about is in 2 to 3 years. A global supply chain, a regional supply chain is not built overnight. That's heavy lifting for our clients. This takes, in my view, 2 to 3 years. But if you wake up 3 years from now, this will be a different world. And as a banker who sits on top of the physical supply chain, our job is to manage the financial supply chain. That will be also a drastic change to our business model.
Thank you very much, Kai. And Sriram, do you have anything to add to that, particularly in and around the impact of the Russia-Ukraine conflict and the additional set of complexities that this adds to global trade?
Sure. I mean, I think Kai has captured very well the geopolitical shifts that are happening and the realignments that are happening. So I won't dwell on that. But I do feel that it creates for banks a greater level of complexity in terms of being very clear about the flows that we are enabling and whether those flows are in any way circumspect because of the origin. And so we have to be very clear about what you're doing. I won't go into what we should be doing and which banks look at which flows as being okay or not okay. But either way, it is a time for us all to be really circumspect about what and be aware of what our counterparties doing and what kinds of flows we are enabling. That's the first thing. The second thing, I mean, apart from the impact of counterparty due diligence, the second big impact is, of course, the volatility, severe volatility that we've seen happen in the commodity markets. And that means that we are having, again, some potential concerns in the ability of the commodity players or commodity-linked players as well, even those in manufacturing who've taken certain positions. At one time, if you had taken a position in nickel, it was a very dicey place to be. Depending upon, of course, you could be in a very good place if you've taken the right bet, but not everybody made the right bet. And similarly, it's gas and oil. It all continues to stay rather at elevated levels, which means that it is putting stress on working capitals and the ability of the players to garner sufficient liquidity to go about their business. We're also seeing the impact of COVID linger on in Asia, especially in China. So that has subdued demand to some extent in terms of actual volumes. But because of the elevated prices, the values still stay somewhat artificially at high levels. So that is the second big impact we're seeing. The third thing we are seeing is, we talked about supply chain, but actually the logistics logjam that is happening in various parts of the world, including Asia, I think is another severe concern. So what used to take 3 days to 7 days to ship is now taking about 30 days. And these are goods which are shipped and they're standing at the ports for a few weeks. So that is a huge impact for the entire supply chain ecosystem. So there are lots of emerging risks, and many of these risks are not local. They are global because trade is global by nature. So we're watching all these things very carefully. The last bit I will say is that I fear that this short-term focus on the conflict and the issues arising therefrom has taken away some of the focus on sustainability that we used to have. So it was starting to, we were hoping we are reaching a tipping point in sustainability, but unfortunately, I do feel that it is going to receive a setback, and we'll talk a bit more about that as time goes.
Thank you very much, Sriram. And I guess there's also the increase in oil and gas prices, and we've seen what's happened with nickel, of course, and it's looking like we'll settle at $100 crude for the rest of the year. But Kai, how is this increase impacting the bank's appetite for lending?
Yeah, I think Sriram touched on that. That's certainly something which triggers a couple of reactions. One, you will see winners and losers. You have to stay on the macro theme. You will have the next net exporter in energy, nation's exporter in energy. They will be the winner. And then you have the net importer of energy, be it crude, be it coal. They will be at the losing end unless their country model doesn't support that. You see this already happening in Sri Lanka. It's one of the first victims. They suffered through the COVID crisis, and now they suffer the high energy prices and takes a toll as we see. My prediction is won't be the last issue we face on a country level. And certainly that puts, and Sriram talked about it, constraint on the working capital for all our clients. From a financing point of view, it obviously gives us the opportunity to bring more volume through our transaction banking pipes, but this certainly remains a challenge. The opportunity here is getting very close to our clients and get it right with the trade instruments in that polarized world, which I've talked earlier on. If you are close enough to the client and stay with them, supporting them with working capital, this is the moment where client acknowledged that the bank was standing behind them. And if you look back 2-3 years from now, they will honor that. And we know this through various crises in the past. So that's the opportunity here, besides the overall threat we have to the economy. Mini commercial break here. By the way, I'm hiring global head for commodity trade finance business and your application if you're a commodity trade finance veteran. Commercial break over. Back to you, Deepesh.
Thank you very much, Kai. And I guess Sriram, as Singapore is probably still grappling with the fallout of those recent commodity scandals and frauds that we saw, will this event and the ensuing reaction, what impact will that have on Asian trading markets for commodity trade finance?
Thanks, Deepesh. Yes, a couple of years back, we did have a big fallout of the scandal. The good thing is that the banking community, as well as the trading community, as well as actually the regulators, we all got together and came up with a set of solutions. So a few things that we did was we actually all agreed on a sort of a code of conduct in terms of what is the right behavior. And it did help us to tighten some of the procedures that needed to be followed if you wanted to participate in commodity trade. And of course, we did leave quite a bit of leeway for banks to have, continue to serve their clients with independence. But at the same time, there was some good guidelines. The second thing, actually, and along with Standard Chartered, Kai, my partner in crime, we also created, we did a POC 2 years back, or 1.5 years back, we completed it, where we created a trade finance registry, and we saw how we could potentially share information into an anonymized box setting, and using that common information architecture, we can actually have an algorithm running to make sure that there is no duplicate financing happening. Because one of the big issues, apart from the one big scandal, actually at that time we had a number of smaller scandals which didn't get as much limelight, but some of them were all basically about round tripping and duplicate notes financing. So the POC worked, and we actually got very good, feedback from the regulators as well as the banking community. So we went ahead and gave the entire idea. We asked the Association of Banks in Singapore, so that is an independent body not owned by any one or two banks, to run it, to take it up and put it into production, develop it and put it into production. And I'm happy to say that that team has made very good progress, and we should now sometime, hopefully before the end of this year, we will actually go into production. And that is the target that we set. So long story, but what it means is that responsible behavior by the various participants in the ecosystem has meant that there is greater acceptance that there will be some degree of oversight and control. There will be some sharing of information, and based on that, we can continue to support the trading community. That is basically the byline. Now, while the registry and has not yet come on board, what has happened is that because of these discussions and some looking over your shoulders and into your processes, most of the banks here, some banks did take the drastic action of saying, I'm going to step back from commodity trade, and that did have a short-term impact. But since then, I would say most of the gap has been filled by the existing players as well as a few more coming in. But this is being done with your eyes open. So we are basically trying to do this with customers we know very well. The processes have been well vetted, and we're comfortable. And we're taking the risk, not simply because the bank next door does it, but because we are now saying we are taking a certain amount of a risk-based approach on this. So far this year, we haven't seen a disruption happening to the commodity trade because of a lack of financing availability. What did happen in the short run-up right after the Ukraine conflict was that when prices shot up through the roof, there was a concern that we might be heading into an economic crisis situation again, and reminiscent of the global financial crisis. So a lot of the big commodity players actually went ahead and drew down a lot of liquidity. So at some point of time, we did see liquidity dry up in the market because everybody was just being extra safe and drawing all the liquidity that they could get. They were talking to the bankers and saying, can you give me more facilities? And that happened. And the good thing was, I think there was sufficient capacity. Yeah, so overall, it's okay. But the core issues still remain, which is, high degree of inflation in Asia and of course, rest of the world, driven by higher commodity prices. The smaller players in the whole ecosystem having a working capital squeeze simply because of log jam, as well as higher requirement of financing. So there are issues. There will be, I think, medium-term issues as well, where some of the players, I think there might be continued consolidation in industry as a result. I think we'll have to be very careful, watchful also on the macroeconomic front. The point that Kai made, will it have an impact on the weaker economies, or the smaller economies in the developing world? I think that is a real big concern we'll have to keep a very close eye on.
Thank you, Kai. I noticed you're nodding your head quite a lot. Would you echo the sentiment of Sriram that the commodity banks did kind of step up their game when that happened? And also, do you see use cases of things like that trade finance registry to stop duplicate invoicing in Singapore and also in other markets?
Yeah, I think that's certainly something we see here. The beauty of working in Singapore is that you have an environment which fosters that culture, bringing the banking groups together with the clients, with the MAS playing a critical role in creating that environment where you can co-create, co-invest, and with a regulatory arm at our side driving that change. But for me, it's even one step further, because the way how we looked at our transaction banking model was very static. So what we need to do, I think, is take a fresh look into the digital journey of banks in itself. So let me try to illustrate that. If you compare the market cap of, let's take the largest 5 transaction banks in the world, let's round it up to 1.2, 1.3 trillion market cap. This is a pretty steady market cap over the last couple of years, actually declines a little bit and includes all the big boys. So now we take a look into transaction banking, fintechs, tech fins and platforms, and combine their market cap and go back the same 2, 3, 4 years where it was essentially zero. And where's that market cap now? It's $1.6 trillion US. So there is market value created outside the bank within the transaction banking arena. So I think what banks need to do is reinvent their digital strategy and in a way spin off part of their good ideas, because Sriram's team, my team, who's better positioned to know everything there is about transaction banking, and yet we have our friends on the fintech side driving their market cap and valuation. Shouldn't be this our market cap we drive? So I think one takeaway is you need to find a strategy to find new growth areas, be it revenue or be it your own market cap, by invest into that area, #spin-off. The second one, relevant for the discussion, particularly here in Singapore, again, who's at the forefront creating right now closed loops, but it has to be a global proposition, is a platform strategy, and Sriram touched some of that. We need to get in the transaction banking space into procurement. We need to get into multi-funder platforms in order to be relevant. The bank channel will remain. I don't think the bank channel is dead, but you need to be more flexible to adopt what our clients need. Does a multinational client want to really onboard 10, 15, 20 banks for their receivable program? Or would it be much easier to onboard one platform and then invite the banks to onboard into that platform instead of having in my example, 10 different proprietary bank channels and the heavy lifting you do. One side of the equation. The second one is the smaller side, which is the SMEs, which need to get onboarded into the financier channels so much easier through technology than going through heavy lifting ERP driven channels. So there are two aspects, and we can drill down a little bit deeper into this. The relevance for us in transaction banking, with an eye on what's going on outside the bank channel, in the platform channel, the procurement channel. I think it's absolutely critical for us to be relevant in the future.
But Kai, and you've painted a really lovely picture there, and I think we'd all like that to happen. What are the biggest challenges? Because right now, Standard Chartered, as an example, is signed on to a number of these different platforms. So what's the way forward, and what actually needs to happen for mass adoption? I guess paraphrasing that question, what is the role of Standard Chartered in the 10 to 20 year horizon? Is it just going to be that debt and liquidity provider, with the front facing being perhaps some of the technology companies or other companies?
Yeah, I think that's a great question, and I would certainly want to hear also from Sriram, because of our friends in DBS on a similar path. You need to be a digital provider. I don't think the traditional bank channel being static is the answer here. And you mentioned the platform investments we have, and there will be more by the way. It's a little bit, and Deepesh, I'm not sure how old you are. I'm old, so maybe some people in the audience will recognize the time where you had the video recorder, right? The VHS, the cassette. It's pre-CD, it's pre-streaming. There were 3 different technologies out there, right? The Beta, Video 2000, VHS. Only one has won. So if you bought the wrong one, translate this into trade, if you bought into the wrong platform, you've betted on the wrong horse. Do I have a glass ball and know exactly what kind of platform, what kind of strategy will be the one prevailing? I don't. This is why we have to spread ourselves a little bit, but not too wide. You need to take a bet as a business owner and saying that is where the future is. But I think the point I've tried to make, Deepesh, is not only investing into somebody else's platform, saying this is cool, I want this for my clients, this is the future. To use our trade IP, our transaction banking intellectual property. My earlier point, who knows transaction banking, trade and cash better than us? The fintechs, they hire a bunch of banker and then they say, I have a solution for you. And then they come to the banks, and then we partner and we educate each other. I want us as a banker to spin ourselves off into something and drive that market cap I've talked earlier about. So there's a platform angle. We need to be clear which platform we're investing in, but there's also the angle of creating in-house solutions, which we then start to spin off. But my view would be quite interesting also to hear from Sriram, who I observing from the inside outside. It's also on that digital journey.
Sriram, is DBS Bank hedging its bets as well?
DBS Bank is doing many things apart from hedging the bets, and a lot of it Kai also covered, but I just explained it from our perspective. So some time back we made a few strategic sort of decisions. One of them is, of course, that you cannot talk about digitization externally, talking about platforms and fintechs, unless you have digitized your own internal processes. So we started at this journey inside out many years back. So, and that has been remarkably successful. And why that is important is that we did things like putting our entire, internal platform architecture onto the cloud. So which basically gave us a lot of flexibility in terms of being able to easily assimilate new capabilities, new locations, new solutions, right? So that was very easy. That made it very easy for us. So that was one thing which we've done. The second thing that we have done is we took to the point that Kai made, we did make it internally easier for people to collaborate with more fintechs and more platforms. So in the past, it was, if you remember, it was always proprietary versus the others. That is always everybody else's competition. So we took the view that actually the size of the pie is huge. We welcome actually the impact that fintechs and digital banks are making in actually focusing on the customer journey. And while I fully agree with Kai that there is huge amount of institutional knowledge and expertise which is there in the conventional banks, most of us, we tend to have also legacy systems and processes. So what these fintechs and the newcomers and startups have come is they come without that baggage, and they are basically questioning everything with completely new eyes. And in some ways, we find that has value, because it is asking us also to say that what was done. If we take a simple correspondent banking settlements across continents, right? You go through your correspondent banking goes to the beneficiary's correspondent bank, and then that goes. It's a four-legged journey, and it takes 2 to 3 days. And then the payments companies have come and said instant payment rails. So they have forced us to actually up our game. So we welcome that. The third thing that we have said is that, to the point, nobody has a crystal ball, but except the customer, because our customer knows which platform he's going to go on, but not all customers are thinking the same. It's a very fragmented, place right now. So what we have said is that let us make sure that we are able and willing to participate in multiple platforms, so long as it is client driven. So if the client wants to be on X platform, we want to be able to serve them on that platform seamlessly, easily, and with minimum of fuss. So these are some of the change in approach that we have taken. Of course, internally, what you also said is that the largest customers typically will go onto platforms. They will choose multi-bank platforms and all that. However, the SMEs, the mid-cap companies, they don't have the luxury of doing that. So we also said we must give them a really good digital experience. So we also upped our game as far as our proprietary capabilities are concerned. So our own supply chain finance capability, actually over the last 3 years, we've completely refined it. And we have heard back from customers that it feels very fintechy now, because the experience, the turnaround time, the feedback loop, everything now replicates what one of the best fintech apps will do for you. So it's important for us to actually up our game in a sort of a 360-degree kind of an angle. You cannot just say, it cannot be unidimensional or bidimensional. You got to place bets in multiple slots in order for you to figure out where the win is. And the win doesn't come also in a single big roll of the dice. It comes with multiple customers.
Thank you, Sriram. And I guess we've talked about fragmentation, but I think there's also an area of fragmentation around digital islands, regional digital islands. You've got separation in China, Southeast Asia, Western Europe. And Sriram, what do you think that means for the development of platforms and the digitalization of trade finance in general?
The easiest answer to that is actually 3 letters, APIs, because what it really means is that you can now use that. It has come up. We pioneered with APIs a few years back, and we thought of it as an experiment and something new, and it's very useful and easy to do microservices. You don't have to have a full-fledged big implementation like a SAP implementation or ERP implementation. But then, to our surprise, actually it really took off. And what I'm a big fan of the fact that we can seamlessly integrate multiple platforms, multiple ERP systems, and with our own bank platforms using APIs in a very short period of time with low cost. So I feel that the days, I have stopped talking about interoperability for a long time because I think it's a distant dream. And that is primarily because we are on the one hand talking about innovation. Now, for interoperability and common standards and everything to happen, you need an extremely centralized environment. Whereas we are saying innovation is getting decentralized and democratized. So it is a contradiction in terms. If we, on the one hand, we want to innovate and we want widespread innovation, but everybody should use the same code. It doesn't make sense. So I think the next bet is how do we create options for interconnecting those platforms rather than interoperating between those platforms. And I think for us, APIs work well. We also have used, in Singapore, we've done another thing. Again, Standard Chartered is also a co-creator of that. So something which we call the SG TradeX, right? Maybe Kai will also talk a bit about it because we are founding members of it together. So what we basically created in Singapore is a common data highway so that multiple digital islands, whether it's the ports authorities, whether it is the logistics providers, it is the banks, it is the shippers, shipping lines, they all can actually seamlessly provide data through this common highway. And then the users, based on use case, have permission, and they can draw upon the data. So the need for interoperability is primarily so that data can flow freely. So what we have tried to fix it is basically with the help of, Singapore government regulator sponsorship. IMDA is the mover behind this. And we are seeing that is one way maybe to fix the interoperability issue. But that is still domestic. We recognize that. So the next bit will be, the government is cognizant of that. There are a number of G2G initiatives and discussions happening as to how we might actually go beyond Singapore borders and create that interoperability. So once you have, let us say, global banks or regional banks, or you have shipping lines, they can actually use the same mechanism to provide information on a more regional / international basis. So these are some of the ways that we see we can overcome the issue of digital islands and the lack of common standards. But I think we got to move beyond that, because for too many years we've been talking about digital islands and interoperability being an issue. I think we moved beyond that and we found solutions either by design or by destiny. I don't know, but we found it.
Thank you very much. I mean, it's really refreshing to hear that, and this data highway sounds really interesting, and it potentially has legs. And actually, if we circle back to your earlier point, and Kay, I'm going to switch the conversation now into kind of the use cases for data and trade tech to actually help address some of the consumer, bank, practitioner issues and challenges around greening up trade finance and supply chains, and also really shifting the focus to ESG. And I know at Standard Chartered, it's a really, really important topic. Kai, how can data from trade tech tools be used to perhaps monitor carbon emissions on shipments? And how can those insights actually be gathered to promote green energy standards? And perhaps you could talk through some examples of what you're doing at Standard Chartered.
Yeah, sure. That's certainly a topic close and dear to our hearts here in Stanchart. Before I go to that lens, let me try to explain why this is not a nice to have topic for a conference. This is here to stay, because what you saw, going back to the client level, what you saw, let's call it the 1960s, 70s, you needed a product to sell, really good quality product, and you sold the product. And then the marketing came. You needed the Adidas, you needed the Nike marketing campaign to sell your products. You need a good product and you need fantastic global marketing to sell your product. That is changing to product marketing and sustainable design and sustainable sourcing. There's a third element now, how you will only be able to sell a product going forward. You see this more and more in the restaurant. You see organically farmed, sourced organically in your food chain. You see it everywhere. You go to your store and buy a kitchen knife, you say manufactured in a sustainable manner. So these three elements, product marketing, but also sustainability, there's a new driver for consumer behavior. This is how our clients are adopting. So we are here as a banker on the financial supply chain. What I just talked about is the physical supply chain. So we need to find a way to merge that, and that exactly brings us to your question about data. So the data is required, in particular in transaction banking, to make a almost split-second decision. Is that product, is that shipment, is that container originating and going to and from a sustainable source? Unlike a solar project or windcraft financing, we banker like to talk about, you have time to make your due diligence and makes a bit of headline. If we want to really solve sustainability as a bank, we have to address the sustainable financing of our supply chain. That is where the carbon emission sits. The solar doesn't change the world. We need to change the physical supply chain into a sustainable physical supply chain alongside with our clients. So data plays a critical role. Step one, however, is to have a framework. You need to be crystal clear what constitutes a sustainable shipment, a sustainable financing of that physical supply chain. If you're not crystal clear as a banker, how can you make then the split-second decision? So you need a framework, and we are proud that we launched in May this framework, and has a massive uplift clients coming left, right, and center saying we want to learn more, we want to bank our physical supply chain on that sustainable financing Stanchart is providing. Step one. Step two is the data. So now you have the framework, but how do you decide if it's coming from sustainable source or not? And that is only driven by data, because the invoice financing, the letter of credit, I can't make 3 months due diligence on that. So we need to attach the data into the information of the instrument. And that is something where big tech and small tech has made big progress over time. Let us illustrate that. You're at the farm gate. Is this an organic farm? Is this a sustainable farm? Or is this coming from the neighbor who's burning Sumatra rainforest? Do we have an eye in the sky who monitors the truck going from this farm or that farm, going to a segregated warehouse? Or is it all commingled? Does it go to a vessel, electric powered vessel? Does it go to a production facility which uses solar energy and wastewater treatment? Or is this a dirty neighbor on the other side? I need data identify dirty neighbor or production site which uses sustainable method for their production real time in my financial supply chain. And that's again where data comes in. Singapore again here with a green initiative on the forefront, but that has to go outside the closed loop we are creating here into global trade. So that's a partnership we need with the small tech, big tech to give us that data. And I've thrown in a couple of points where you can make the math who has that data, who you want to partner with to get that right. So it's absolutely critical, important to do this. Very quickly, third element is the incentive. We are doing the right thing here. We all want to do the right thing, but at the end of the day, we are bankers. It's about dollar and cents. So the incentive is give an incentive, a financial incentive to do sustainable trade finance, which is more attractive financially than the other side. And how do you do this? You partner with the multinationals. They are eager to support the banks. They are eager to support us and saying, I give you preferential terms, but you need to show me the evidence that this is a sustainable financing. Framework data, that brings our friends from IFC and ADB over the line saying, I partner you for preferential terms, which you then can give big into your supply chain, to your clients, to the supplier who needs it. These three elements you need to get right. And we are on the journey, and this is not, guys, a Stanchart journey. We need to get that collectively right. This is not the moment where one outshines the other. Collectively, we need to get it right. So friends in BAFT, get it together, get us together to come up with a framework. One of the missing pieces here, we need a framework. It's not the Stanchart framework, it's not the DBS framework, it's our framework we all operate against and execute against us. There's some more work to be done. So friends in BAFT, help us.
Thank you very much, Kai. I mean, Sriram, business imperative or nice to have? I mean, it's very clear that data is absolutely key here.
Yeah, I think data, and I don't want to belabor the point where Kai has actually explained very eloquently. And I'm very aligned with what he described, because we are also doing many things along the same lines. A few extra things I would just add on. One of them is that, we are quite keen to enable industry level agreement on certifications. But the problem is that every industry itself requires its own certifications and standards. And it's a big job for us to make sure that every industry and every participant follows a similar definition, which is the point about taxonomy and framework that Kai talked about. So we have our certain sponsorships. One of them is called Hevia Connect for the rubber trade, where DPS has sponsored the creation of this. And what we hope to do is to use that to have multiple buyers and sellers, so it's basically a marketplace, and it is a digital marketplace. So you can buy and sell. These are for wholesale, players, including tire manufacturers. And what we are now hoping to do is to create certification on top of that, which is on the platform. And therefore, it hopefully becomes then a commonly acceptable standard. There is no single standard today. The second thing that we are doing is in Singapore, we're part of this as a standard charter. part of the Green Trade Financing Initiative. It's called GFIT, Green Financing Industry Task Force, which came up with a white paper and tried to create a common taxonomy. So I would just leave it by echoing Kai's point that it has to be more global, and we should leverage industry bodies like BAFT to make that happen. Now coming to data. So a lot of the times when we talk about certification and enabling sustainability, we talk about two things as if they were one-to-one. So it is not about simply certifying that this particular ship or this particular building or this particular customer behaves in in a sustainable fashion or an eco-friendly manner. But actually what we are finding is that the data around Scope 2 and Scope 3 emissions are absolutely so nebulous as to evade accurate measurement. And this is directly from our customers who said that these are in agri-businesses, the largest names in the business, who come and said, we actually went along this journey and tried to say, how would we get better at measuring our current carbon footprint? But they said the moment we go outside our own corporate into our suppliers whom we are, whether they are behaving properly, our transport, Scope 2 and Scope 3, they are saying that the ways to measure that are extremely fragmented, disparate, and very difficult. And the only way we can do that is actually by leveraging data. And the benefit of data is it doesn't need, once you create the architecture and the ability to onboard these various players onto a platform, it doesn't have to be a single platform, it could be a blockchain-based platform, but basically on a common architecture by which data flows, you can actually enable more than one objective. And that is where we think there's a benefit of it. So apart from certifying and monitoring carbon emissions and sustainability certifications, we can actually use the same, leverage the same to say that data is actually good for me to actually finance a supply chain. So it is also good enough for me to actually go and give the small supplier sitting in, say, Sumatra, to Kai's point. If we have the right data, we can actually start financing them and enabling them to also come up the curve, not only purely on sustainability measures, but also things like financial inclusion, better working capital access. And therefore, you can actually meet a lot of objectives at the same. So the thing is to get people on a common architecture whereby the data can flow freely. And that is easier said than done. The other thing, I just want to touch upon the fact that a lot of commerce, switching tack, is moving to e-commerce. And just as you and me are much more comfortable buying, from t-shirts to refrigerators online, whereas we would have gone to the friendly neighborhood, mall in the past, I think that is also creating its own opportunities and challenges. Opportunities because it's all digital, so data is potentially available, and therefore you can start financing merchants. And difficulties because the financial system is geared towards large ticket transactions. But now, if you want to buy a T-shirt worth $10 and you have to make a cross-border remittance, and you pay, X times of that $10 to make the transaction happen, it has lost, its efficacy. So I think the world is changing, and therefore we have to change with it, and our business models need to also adapt. And I think using data effectively to understand which market segment what is right for what business model, I think these things we are all only starting to get better at.
Thank you very much, Sriram, and what a great overview there. We just have a couple of minutes left on our panel session, so I'd like to end with one final question, really talking about, and I know, Kai, you said you didn't have a crystal ball, but I'm going to ask you to get your crystal ball out and perhaps talk about the major trends that you see for Asian trade in the next few months or so. So Kai, over to you, and then I'll pass on to Sriram. Just 60 seconds or so, please.
Yeah, sure. Thanks, Deepesh. Yeah, I do not have a crystal ball, but I have a prediction to be made, and that goes back to where I started. We live in a deeply disrupted and polarized world, and if you go now into hibernation, you take a deep sleep and you wake up 3 years later, I guarantee you the supply chains are not as you used to be. So we've grown up in trade over the last 20 years in a relatively stable environment. Sure, we all had Lehman and a couple of European and other crises, but nothing of the scale of changing supply chain you will see for the next 2 to 3 years. Why 2 to 3 years? Because again, as I've said, it takes a while to rebuild supply chain, have a new market, have a new infrastructure. And that is something where all of us need to have an answer to. You can't go into hibernation, not actually being on hibernation, but standing there in 2 to 3 years and saying, oh, the guy from Stanchart was right, I'm not prepared. So all of us need to make the homework to be prepared for that. That's my crystal ball, my glass ball, want to leave here with our BAFT community.
Thank you, Kai. Be prepared and don't fall asleep. Sriram, over to you.
I think that I would just break it in two parts. I think we are in for a bit of headwind in the very short term, as we are already in the middle of it, and I do feel that there's going to be a bit of short-term pain, some more to come, macroeconomically, geopolitically, and including from the remnants of COVID in different parts of the world. So I think that is here to stay, and therefore that brings to my earlier prognosis that I think a certain amount of vigilance on both the compliance as well as the credit areas of our business will continue to be paramount. But if I were to throw my mind a bit to the future and gaze into my crystal ball, which is here on my desk, I see a pretty rosy future. But that is primarily driven by digital and data. And apart from the ways that I've talked about how we might do track and trace, how we might interconnect between different platforms, I think there's one extra thing which is happening, which is Web 3.0. So what that is really, that means for us is that new opportunities and business models will open up. There will be some disruption, but I think it gives us great opportunities to look forward to. It democratizes the ability of people to participate in business as well as to participate in finance. It really opens up opportunities for everybody. It's no longer so centralized as before. So I think there are opportunities galore, but to Kai's point, we cannot afford to be asleep at the till. We need to constantly innovate all the way through to that medium term that I'm talking about. Otherwise, we will fall back.
Sriram, Kai, it's been such a pleasure talking to you guys with our panel discussion, A View of Asian Trade at the 2022 BAFT Global Annual Meeting. Look forward to hearing from you soon. Thank you very much.